There's one very favorable taxpayer provision is that real estate is real estate is real estate. And by that I mean I can sell an apartment building and the reinvestment can be in a piece of farmland or vice versa. As long as it's real property, it's very forgiving.
Hello, and welcome to another episode of It Depends, a podcast series brought to you by Hanseman Weeble. You know that if you've ever talked to an accountant, they've told you, well, it depends. This podcast series is for business owners, leaders, operators, accountants, or someone just wanting to learn more about the accounting industry. I'm your host, Clarissa Hoffman. Today, we are joined by Larry Martin to talk about like-kind exchanges. Thanks for joining us, Larry.
Glad to be here.
Can you tell us a little bit about yourself?
So I'm a CPA, obviously with Hanseman Weeble, a Charlottesville native, and made a choice to come stay in Charlottesville after I got out of school, and have been in the tax practice here and have enjoyed that, enjoy working with our clients and being a problem solver. So it's been a wonderful experience.
Well, you're a problem solver for a lot of us. So please tell us about the basics of a Section 1031 or a like-kind exchange.
So like-kind exchanges are a provision in the tax law, and they are a tax-deferred transaction. They are not a tax-free transaction. People often refer to them as a tax-free exchange. They're not. They simply defer the taxes to a later date. And it's a provision in tax law that's been there for many years. Since 2017, it only applies to real estate. It used to apply to other types of property, but now only to real estate. And it's an ability when I sell a piece of property, if I want to reinvest that back into more real estate, if I will follow certain rules, I can defer the tax and not pay current tax on the profit that I'm going to make on that real estate. So it's a very workable tool for people in the real estate business.
So you just told us deferring tax is a big reason that you would want to do a 1031 exchange. Are there any other reasons that you might want to do one?
Well, I think it's really, to me, an investment decision. Again, I presume that they're attractive to people who have a large profit, and certainly in our recent real estate market, property values have appreciated significantly, and so there are some attractive sales that come with a significant gain and therefore a significant price tag. And if I want to put those same money back into other real estate, then the 1031 exchange is an attractive way to do that, because I can not only reinvest my money, I can reinvest the government's money into the new real estate.
Are there some reasons that a taxpayer would not want to do a 1031 exchange?
I think there are a number of reasons. Number one, from an economic standpoint, if I had a highly appreciated piece of real estate and sold it, do I want to put all of that money back into another piece of real estate, or do I want to take some or all of that money and invest it? And so if I want to disperse it or diversify into something else, or I need the money for something else, then the like-kind exchange is not attractive because the reinvestment, the only way to defer the tax is to actually reinvest, the proceeds into new real estate. And other reasons may be that somebody has, for example, large capital losses from other sources that are available to offset the gain that would come from the sale of the real estate, and they would rather offset the real estate gains against those capital losses than do a like-kind exchange, which simply defers it and ends up with new property with a low basis.
So it's certainly not a one-size-fits-all.
Absolutely not. It is like many tax tools. It needs to be tailored specifically to the needs of the individual in the individual situation.
So let's talk a little more specifically. Say you sell a piece of real estate. Do you have to reinvest all of the proceeds, or can you only reinvest a portion of the proceeds?
It's not an elective provision, but you do have to follow the rules for it to apply. But basically the way the rules work, if I take money out of the deal and don't reinvest it into new real estate, I pay tax on those dollars, and we refer to that in the transaction as boot. So any cash that I get is taxed, and I can decide to reinvest part of it, but not all of it, and keep some cash and therefore decrease my amount that I have invested in real estate. One of the things you have to be careful when you do that is how much debt was on the old property, how much debt's on the new property, because if I get relieved of debt, it's treated like money, and that is taxable. But I may want to take a piece of property that I sold that had a lot of debt on it and just reinvest the net so I don't have debt on the new property. I'll pay some tax on it. It's clearly not an all or nothing. I can pick and choose in how I design the transaction.
Are they easy to do? Are there any other things that taxpayers should be aware of?
They're easy to do, but they are very exacting. The original law was actually where I actually had to exchange my property for another property. And then some innovative taxpayers came up with a theory of, could I just park the money somewhere and then do the exchange at a later date, referred to now as a deferred exchange? And those eventually got okayed by the courts and enacted into the law. So basically, a couple of ground rules. I can never touch the money. The money has to go to what's called a qualified intermediary, or QI, who holds on to the money. I have to tell the QI what prospective properties that I may want to reinvest in. That has to be done within 45 days, and it's a very exacting 45 days. And then I have to also reinvest and actually close within 180 days or the due date of a tax return. So if I do a like-kind exchange in November, the due date of my tax return may be before the 180 days is up. This is a trap for the unwary, can extend the return and get the full 180 days. But it is, they're easy to do. There are a lot of professionals who do them and do them well. You should engage if you want to do one of these transactions. Make sure the professionals are very competent and experienced in this. So while they're easy to do, they're very exacting. If you miss one of the deadlines, then you will pay tax. And if you fail, it's an all or nothing. It doesn't mean part of it gets taxed. If you miss the 180-day deadline or one of the other deadlines or do it wrong, the whole thing's going to be taxable. And at that point, your money is reinvested in a piece of real estate by the time you discover the error, and now you have no money to pay the tax with. So it's not, make sure you do it right.
So the scenario that you just described to us is a big pitfall. Are there any other pitfalls with doing a like-kind exchange?
One of the biggest ones we probably run into is the taxpayer who must reacquire the new property is the same taxpayer who sold the old property. One of the common occurrences we see that is a problem area is if the owner of the property that is being sold is an LLC, taxed typically as a partnership. And we run into the scenario where the partnership sold the property and one partner wants to reinvest and the other partner wants their money. And you cannot do that in 1031 because the partnership is the entity, not the partner, who has to reinvest. And this causes a lot of confusion and problems. There are ways to work around that with proper planning, but you can't wait until you get ready to do the transaction. If you let us know a year or 2 years before you do it, there are ways to work around some things like that. But there are some planning, kind of pitfalls to making sure that you follow the rules. And then, like many things in our tax world, we have a lot more opportunities if you will plan before you do the transaction than simply trying to, after you've already got the transaction, signed documents, etc., decide you want to do this. So again, I encourage people to be in front of their well ahead and consulting with their tax professional well ahead of the time to plan.
How do you report a like-kind exchange to the IRS?
It's reported on the taxpayer's tax return. The taxpayer, in this case, could be a partnership or an individual, depends on who owns the property. And there's simply a form that goes in the individual return or the partnership return that tells the IRS what date you sold, how much you sold it for, how much debt you were relieved from, where you reinvested it. So it's simply a matter of reporting on the income tax returns. One point I would make that I think is important is There's one very favorable taxpayer provision is that real estate is real estate is real estate. And by that I mean I can sell an apartment building and the reinvestment can be in a piece of farmland or vice versa. As long as it's real property, it's very forgiving. So I don't have to exchange an apartment building for another apartment building, or I can just do it for another piece of real estate. The property must be held either for investment or for use in a trade or business, could be part of my active trade or business, or rental is the one we see most often, is an active trade or business. I cannot do it with a personal use asset. So if I have a vacation home that I've never rented out, I can't exchange that because it's not an investment asset and it's not a trade or business asset. So both the property you give up and the property you acquire must either be held for investment or for use in a trade or business. But again, you can go from an investment property to a trade or business property as long as it's real estate.
That's a great point of clarification. Thank you so much for your time today, Larry.
I enjoyed it. Thank you very much. So, Clarissa, you're doing many of these. Do you know what your next topic's going to be?
Well, it depends.